Hello traders, welcome back to Nova channel and let's continue another topic for technical analysis today. In this video, we will learn about the tweezer top. The tweezer top pattern is not an abrupt reversal, but the result of a battle. A battle where buyers tried to attack twice in a row but failed both times. Today, we will decode this pattern to understand what struggle and find the highest confidence entry points. But first, we need to know what is a tweezer top. The tweezer top is two candlestick bearish reversal patterns where the highs of both candles are identical or nearly identical in price. The pattern indicates a possible end to an ongoing uptrend. When the tweezer top appears at the highest price level during an uptrend or during a major retracement in a downtrend, it can signal a strong reversal. Essentially, this pattern acts like a selling that may eventually trigger a sharp reversal from the prior upward move to the downside. The tweezer top illustrates how the overall market sentiment is shifting against the bullish momentum needed to keep the trend intact. This occurs due to increasing selling pressure at elevated price level, which forms a significant resistance that prevents further bullish advances. This buildup of selling pressure can then initiate a counter move to the downside, which is why this pattern is a bearish reversal signal. And now let me show you how to identify the tweezer top pattern. Here are 4 crucial criteria for pinpointing a valid tweezer top pattern on the price chart. The first thing we need to pay attention to is the price level. The two candlesticks must have identical or near identical highs. And for the first candlestick, it must be a bullish candle to signify that it is still part of current upward move. Ideally, a bearish candle, which is a neutral candle, is still valid but less ideal. This means to denote the starting point of a shift in the market sentiment. And where is it located? The two consecutive candles must appear at the highest point of an ongoing uptrend or during a major retracement in a downtrend. Here are different variants of tweezer candles you are most likely to encounter on the price chart. Shown above are 2 standard variants of tweezer top. The first variant consists of 2 consecutive candlesticks, both having long shadows and relatively shorter real bodies. In contrast, the second variant consists of 2 consecutive candles with long real bodies but much shorter shadows. Nevertheless, despite both variants being considered valid formations, the first variation arguably provides a much stronger signal for upward trend reversals. This is because the long top shadow from the first bullish candle already indicates strong selling pressure, pushing the price to the closer lower. Then, the second bearish candle attempts once again to break this area of strong selling pressure but fails. The first variant illustrates the attempts and rejections at the high. Hence, this signals a likely start of a bearish reversal, compared to the second variant, which does not clearly show a strong area of selling pressure. And now, let's move to the next variant. Here, the third variant is also considered a bearish engulfing pattern, where the entire range of the first bullish candlestick is engulfed or covered by the second bearish candlestick, demonstrating the strength of the second candle's selling pressure. This makes it an even stronger pattern for potential trend reversals. On the other hand, the fourth variant is considered an inside bar, whereas the first candlestick covers the entire range of the second of a much shorter candle on its own. An inside bar signifies indecision about the trend's next move and requires a confirmation candle to validate whether it's a reversal or continuation pattern. However, when the inside bar's 2 consecutive candlestick patterns form a similar high, then it reinforces a possible reversal signal. And now, let's check the next variant. The fifth variant of tweezer tops features a neutral candle or some variation of a doji. While this remains a valid tweezer top pattern, is it generally considered a less reliable signal for trend reversals. This is because, unlike a bearish candlestick, a doji may simply indicate a pause rather than an outright reversal. Also, even if we look at the volume, regardless of whether it is below or above average, it does not confirm a clear direction. Lastly, the sixth variant consists of a bullish candlestick followed by a 1 candlestick reverse formation known as an inverted hammer or a bearish bean bar as the second candle. Essentially, It signals a rejection of a higher price, as evidenced by a long upper shadow. Nevertheless, the second candle must have above an average volume, as Low's volume could mean only a temporary pause before the upward move resumes. And now I will show you the examples relating to the Tweezer top candlestick patterns. The first one, successful trend reversal play scenario, uptrend to downtrend. As you can see the illustrated photo, there was a clear upward trend before the Tweezer top pattern forms. As discussed in the early section, the two candlesticks meet the criteria of having nearly identical highs. It then successfully served as a bearish reversal signal. As we can see, a downtrend eventually followed. Nevertheless, this is the best case scenario when using Tweezer tops to guide any of your trading decisions. And now let's move to the second example, failed trend reversal scenario, which is uptrend continues. In sharp contrast to our first example, while we can also observe a prior upward price trend before the Tweezer top pattern forms, it did not successfully serve as a reversal signal. This is despite the fact that the two candlesticks technically satisfy the pattern's validity requirements. This represents our worst case scenario and demonstrates that this candlestick pattern is imperfect and, in fact, can often fail, especially without considering entire market context, which we will discuss in the following sections. And now let's move to the third example, indecisive outcome scenarios, which is uptrend to sideways. Our third likely scenario is when the pattern does not lead to either an uptrend or a downtrend. As shown, there was a prominent upward trend before the formation of the Tweezer top patterns. Notice the same high price of the two candlesticks. Nevertheless, it resulted in the sideways price movements, establishing a clear support and resistance areas, with the Tweezer top high serving as a new resistance. Our last example today is as below. A Tweezer tops appear frequently within the forex market. Above, we will see Euro USD on weekly chart for 2 weeks in a row. Two long-range candle stops at the same price high. After some sideways consolidation, Euro USD retested those same highs again. After another failed attempt to break, prices began to fall again. Part of the reason Tweezer top forex is common due to the 24-hour continuous trading that forex offers. When a resistance level forms, oftentimes the price will have a hard time punching through the resistance. Breakout tends to be more volatile forex when there is a shift in interest rate expectations or uncertain market condition. Otherwise, forex can be a very technical market and respects support and resistance levels. And that's it. That is the lesson today. See you in the next video.